The market did open here down around 1%. It then recovered and fell momentarily as the inflation numbers surprised. You can see here that at the close, the ASX 200 was basically down some 0.78%. It takes its loss in the past week to almost 4.5%. Looking at the best performing stocks, it was all about mining today. Coal miners, iron ore miners, they rebounded after yesterday's falls. And you can see there, Whitehaven Coal up by 5.5%. You've got Champion Iron up by 2.95%, Fortescue up by 1.5% there. But this was more than offset by those going backwards. So this was gold miners. Northern Star, you can see they put out a quarterly report. It was down 4.9%. Resolute down by 5.2% there. And tech shares also under pressure. Appen, PointsBet, the payments company Zip and Credit Corp also fell today. So let's try and work out the market reaction to this inflation number, but also the worries about a potential global slowdown caused by China's COVID lockdown. Matt Sherwood is the head of investment strategy at Perpetual and joins us now. Matt, many thanks for your time. I just want to start off on that very one point about, the risks right now of the overall economy, given the slowdown in China, given what's taking place in the United States, given the fact now that interest rate rises in Australia seem inevitable, and lots of them, by the way.
Yeah, there's no doubt, Ross, that risks are to the downside with interest rate increases, and we might get a temporary bounce from the Omicron drag being consigned into history, but there's no doubt that the RBA's got to get their skates on. Unemployment's going to be sub 4%, so it's certainly not a time for emergency policy settings. And of course, inflation now is elevated, but I would say Australia's probably done better than the average G25 economy. But of course, when inflation's almost double the midpoint of the target band, it's pretty clear that policy's got to be tightened.
So one thing about this, is there anywhere for investors to hide right now? Because, generally we're talking about the markets. You can see some sectors, they're bouncing around. The volatility is pretty intense, but where do people go and hide?
Well, the challenge with the markets is multifaceted at the moment, Ross. Not only are valuations very high in both bonds and equities, but interest rates are increasing like we've just discussed with the RBA. They're going up very, very sharply in the US. And at the same time, we have this cost side inflation, so earnings are coming down. So a combination of high valuations, higher interest rates and lower earnings growth is not a good combination for markets. And at the moment, even the safe haven equity sectors like utilities, healthcare, consumer staples, they're trading at very, very high valuations. So they may outperform on a relative basis, but my suspicion is the market is going down on the basis of those three significant headwinds and really the absence of any kind of tailwind other than a robust labour market, which is reinforcing the move of central banks to increase rates.
And just very quickly, one aspect could be China. It's the slowdown that's dragging down significantly around the world. But I wonder, when it opens up from these COVID lockdowns, it has to start to stimulate. I wonder whether that might be the saving grace.
Well, it could be a little bit of a tonic to global growth, but all of China's slowdown is self-inflicted. We have this moderation or restrictions within the construction sector. We have zero COVID. So all of their wounds are self-inflicted. But we do know with Omicron, it's about an 8-week wave from the uptrend to the downtrend. But then you've got the property issues to deal with. So President Xi today has announced a kind of new deal like Franklin Roosevelt to get the economy moving. Now, that really shows you the economy at the moment is pretty weak. And the challenge is trying to get the private sector to invest.
Yes.
And normally when you cut rates and provide fiscal stimulus, the support comes through the construction sector to the real economy, but that channel's blocked now. So to me, it's really the exchange rate and government spending, which is going to have to be the answer.
Good on you, Matt Sherwood from Perpetual. Great to get your insight on all of that today.